It's Monday, the 26th of September, 2011, and in this Boardroom Talk special podcast, Alan Card, who's the Chief Executive of Amalgamated Appliances, or AMAP, joins us now. Well, the market likes your numbers, Alan, for the year to end June. I see the share price is up 7% today to R1.83. It's a while since you've been there.
Yes, Alex. We are quite proud of the numbers as well.
It's a big turnaround. You've had a 3-year real hard grind at this. Have you lost a few years on your life?
No, I think the team have embraced the challenge. It's been quite tough going through and saying goodbye to certain people in the company, or all the people that left us. That was very tough. But we're now at the sort of the invigorating time where we're looking at growth, we're looking at regenerating and driving the brands, getting market share, launching new brands. It's an exciting time.
How many people have actually left you over this period?
It's been significant through retrenchments and getting rid of certain of the businesses, selling them off. We've lost probably about 700 odd people.
I see your chairman has also resigned. Leon Camphor stepped down from the board. What's behind that?
Leon has been with us right from the beginning when I joined as the chairman, and he really did an outstanding job. He has responsibilities in the financial services industry, and he talks for the financial services industry to government. And unfortunately, he just hasn't had the amount of time to spend on our business.
So it's more a question of he's done his time, he's now got to focus elsewhere.
That's correct.
And your new chairman, David Cleesby, where does he come from?
David's from Bidvest. He's the financial director of Bidvest. We're very pleased to have him on board as the chairman, and he chaired his first board meeting, and we are really honoured to have him on our board.
So there's a close relationship with Bidvest?
Yeah, Bidvest own 27% of the company.
Is there any intention by them to extend that?
You know, Brian, they purchased the company in November 2 years ago, the 27% from Steinhoff. They've brought a lot of credibility and a lot of know-how to the company. I don't think there's I don't think there's any intention to change what they're doing at this point in time. But if you know Brian, he plays his cards very close to his chest.
Indeed he does. Well, let's have a look at the numbers, and they really are looking strong. This is for the year to end June. You've, I suppose most importantly for shareholders, managed to take your dividend from 8 cents to 12 cents. It's a cap issue or cap distribution, but it's the same thing. Shareholders will get 12 cents, whereas they got 8 cents a year before.
Yeah, 50% increase in the dividend.
Where was that, or how important is that for you to make sure that you put money into shareholders' pockets?
Well, we've been generating a lot of cash as we've been restructuring the business. And as a board, we discussed the dividend. It was important to get it in line with our new business model. We need to retain a certain amount of cash in the business for the acquisitions. We also need to look at our financial structure, because at this time, the financial markets are very, very uncertain. And to raise cash through overdraft LC facilities is very difficult. But we took the whole lot into account, and we're very positive. So that's why we've increased the dividend.
So you have net cash on your balance sheet now?
260 million.
No borrowings?
No borrowings.
That's a good position to be in, and you're putting it to good use. Just tell us about this acquisition, the 70 million rand acquisition of Sameg Satellite. It sounds a little outside of your core business.
Well, our business is split into the following areas. We're in housewares, we're in personal care, we're in sewing, and we're in appliances, small appliances. And the other category that we're in accessories business. We had a good look at the satellite business, and a large slice of their business is the actual accessories that we sell through our accessories business in the electronics side. So there is a good balance, there is a good fit for us.
What products are those exactly?
They're plugs, cables, dishes, brackets, that sort of thing.
Do these guys import them, or do they actually make them?
They import them.
They import them. So it's another line that you'll be able to bring into the business.
Yeah, fits straight into the organisation.
Alan, where do most of your imports come from now?
Most of them come from the east, from China, and maybe a little bit from Pakistan, a little bit from Thailand.
And the quality over the years?
You know, what we've done is we've put engineers through into the east. They sit in the production lines, they look at the quality, and that keeps the quality to the standard that we want.
And there's no problems from the manufacturers?
No, look, you know, the quality of manufacturing from the east is absolutely outstanding today.
What I mean is if you have your own engineers on their production lines, they don't mind about that?
No. They're very supportive of what we want. We even look to buy some of our own tooling, put on the production lines. It's a sort of integrated effort with the manufacturers.
Very different to the old model of a big manufacturer selling to a distributor in a small country like ours.
Yeah, look, it's changing. I mean, people looking at manufacturing, that's what they specialize in. And they're not looking to fulfill the whole value chain. And they need to give a service to bring countries and companies like us into the fold.
How have you found dealing with Chinese manufacturers?
Tough. They're demanding, always, but they're men of their word, but really tough to deal with.
From a price perspective?
All aspects.
Okay. You're just going back on the 3 years of your restructuring and the way that your business is positioned now. You've got a net asset value which is quite a lot higher than your current share price. R1.83 is the share price. Net asset value at R2.33. I guess that would be your first intention, no doubt, to get the share price above NAV, because a company like yours that's got a lot of brands shouldn't be trading below NAV.
Yeah, we quite perplexed where the share's trading. But, you know, we've been offered advice of buying back shares, doing this, doing that. But, you know, what we'll do is we'll concentrate on the business. And I think if we can have sustainable results over the next 2 or 3 years, the share price will go to the level that it warrants.
But it's pretty clean now, the business, with net cash on the balance sheet. Interesting to see the way that your stock controls have improved as well.
Yeah, there's been a lot of focus. We're putting in a new IT system around the stock control to improve the levels. So, you know, we're very comfortable that we're starting to get on top of the forecasting models.
Where's your attention going to be focused in the year ahead?
I think of the things that we've been doing, the first focus is on building the brands. We've got a number of new brands that have come in. We need to focus on those. We need to build those one step at a time. So that's the first focus. The second focus is to integrate our business with the retailers. From an IT perspective, from a logistics, from a payment, from a ordering, from a transparency point of view. That's the next objective. I guess those are the two most important objectives.
You talk about new brands. Clearly, your best-known brands, Pineware, Russell Hobbs, a new brand I see you've called Arty Farty. Who thought that one up?
Some of our people were overseas on a show, and they saw the reference to that brand. Came back, we registered it in South Africa, and we launched it.
What exactly is it?
Well, it's a little bit different. It's a little bit arty. It's a little bit bizarre. It's a bit zany. And we've applied it to coffee mugs. We've applied it to dinnerware. We're applying it to stationery. And it's working for us. It really is working for us.
How do you invest in brands? When you talk about the investment that you're making there, is it through what we would know as above-the-line advertising?
It's a combination of everything. So, you know, the way we see it, it's the packaging on the product. It's the product itself. It's the delivery of the product. It's how the receptionist answers the telephone or greets people coming into the company. It's everything that you do represents that brand. So it needs to be an all-inclusive package. And
your top-end brands, which one's those?
So Russell Hobbs and Wilshire are top-end, Remington as well, are top-end brands.
And the Pineware would be more of an entry level?
Yeah, we like to classify it as good, better, best. So in each category in which we operate, we like to give a boutique of offerings, starting with the good and then moving to better and then obviously the best.
For instance, the Russell Hobbs brand, would you source that in the Far East as well, in China as well?
Yes, we source it in conjunction with our principals. We don't own the brand. The brand's under license. Some of the products we source directly ourselves from factories. They've given us the ability to license certain manufacturing companies, and we also source it with them from the factories that they source from.
And local manufacturers, Alan?
We have our own manufacturing facility down at Pinetown. We have 150 staff, and we manufacture about between 20 and 30% of the stuff that we sell.
Right, so that's vertically integrated, but you don't source from local manufacturers?
We source from local guys that will make a portion of the product, but they wouldn't make the full product. I don't think there's any other local manufacturing left now in small appliances in South Africa.
Why do you think that is?
It's tough, eh? South Africa is not a sort of environmentally friendly place for manufacturers.
Well, I suppose the labour issues are one thing, but has it got something to do with the economies of scale.
Yeah,
In other
it's
words,
a-
if you're making toasters here, you can't make a million, whereas in China you might be able
It's
to.
got to do with a couple of things. I would think the first thing is the economies of scale. That's very important. If you make the product, you've got to be able to make it for export. You've got to have big volumes going through. So that's how you get your economies of scale, not just even for the local market. The second thing, you're going to have low input costs. So it's got to be labor's got to be low, and you're dealing with a comparative with China of about 800 Rand. And you lead low electricity, transport, all of those costs need to be low and very competitive.
You say that you're well on the way to becoming Africa's distributor of leading commercial brands. Where else in the continent are you going at the moment?
Well, we're focusing on sub-Saharan Africa and the Indian Ocean Islands. So we're in Angola, we're in Mozambique, we're in Zambia, Zimbabwe, the DRC, in Tanzania, we're moving into Nigeria. So those are where we're focusing, and we're in Mauritius, Seychelles, Madagascar.
Do you need to put distribution centers in each of those countries?
No, look, the logistics, we call ourselves a brand company, and that's what we do. How we do the logistics is different in every country.
So how would you do it, say, into Angola, which we know is a very expensive country?
We would ship it, that's the one way. So we would take shipments and put them on the boats, and they would go around to the ports. The other way is by road.
Alan, looking forward is your area of growth. You do say that in South Africa it's cautious, the consumer's still struggling a little bit. Where would you see the big growth coming from?
Oh, we see the growth coming out of Africa, and we see it coming out of the new categories that we're going into. So we see it coming out of housewares, out of personal care, and some of the new brands that we've acquired.
Alan Card is the Chief Executive of Amalgamated Appliances.